In today's video, we're getting into chapter 20. If you guys have any questions, you can text the number above. And if you guys want to join the WhatsApp group, text that number as well. If you guys need free practice quizzes, link down below. And if you guys want to join the course, link down below as well. This kind of goes over debits and credits. We'll go through it pretty quickly. Accrual and deferral entries record real events, exchanges of money that have not yet taken place or that occurred previously and are being spread over time for accounting purposes. Recording before the event is a way of equalizing timing differences between work you do and payment you expect to receive later. Your accruals should reflect the true financial condition of your business, regardless of the timing of cash exchange. Percentage of completion adjustments. There are roughly 4 types of accruals you're likely to make using this accounting method. They can be defined by top of entry. You'll need to report income not yet paid but reported under this method, defer income received but not yet reported, accrue costs applicable to currently reported income levels, and defer costs paid for but not yet reported. So this is what I was talking about. They kind of go over the debits and credits here, and then on the next page as well, debits and credits, all of them pretty much. So accounts receivable, all sales on accounts should be accrued because no cash changes hands. Pretty important right there. If this entry could be isolated from sales, it would look like this. This kind of, in my course, I kind of go over debits and credit from the contractor manual. I feel like it's easier to understand when you're doing the contractor manual debits and credits. They do a better explanation of this. If you're interested in joining the course, the link is down below. I go over everything so you can pass on your first try. And if you just need to buy practice quizzes, if you're studying for the exam, you can buy them in the link down below. I have those available, and I also do one-on-one tutoring calls. If you're interested, it is linked down below. So back to prepaid expenses. You don't usually pay all your expenses in the current month. You can accrue them for payment in later months, and some of the expenses due pay apply to more than a single month's service. You may pay 3 years insurance coverage in advance. For instance, in the first month of the policy period, it would not be accurate to record the entire 36 months expense in the first month. The entire amount should be classified as a prepaid asset and assigned to an expense account. Reserve this procedure for expenses that apply over 12 months or more, apply for less than 12 months but belong partly in the following tax year. And then once again, they're going over the debits and credits here. Okay, right there again. Prepaid expenses and depreciation. Amortizing an expense over a period of time is not all the same thing as depreciation, although the two seem similar at first glance. Deferred asset. You can treat expenses by paying them and deferring them in your books until a later time. Unlike prepaid asset accounts, which recognize expenses by amortizing them over time, deferred asset accounts are set up for payments you make now that will be recognized at a later date. A security deposit is refundable and should be placed in an asset account. Pretty important. Controls. Know at any time exactly what items are in prepaid assets, deferred liabilities, and provision for future losses accounts. The cash account method. The other method of accounting is called the cash method. In this method, as we have seen in earlier chapters, you only record exchanges of cash and financial statements, show only cash exchanges. You can use this method for income tax return, but only if you do so every year. All right, that's going to be it for this chapter.